And here's an idea where of the, what the federal funds rate actually is and how it's tracked over time. I do remember I had a developer friend years and years ago, and he was telling me about a meeting he had with an investor who said this was in the 1980s that the federal funds rate or the interest rates in general would be in the single digits, right? So look at where we were here in the 80s, where they're like in the 20%, right? So that means the federal funds rate alone was 20%. So by the time, so what that means is if you wanted to rent go for a mortgage, right, you would be paying above that, right? Because it's a longer term thing. There's more risk in that investment. So can you imagine paying more than 20% on a mortgage to buy a house? It's just insane, right? So we just went through a time where it was practically zero, where people were saying, oh, the rate is 3.5%. Well, that's too high. I want like in the twos, right? So that is the extreme that we've seen in, well, many of our lifetime, mine anyway, right? So we went from in the double digits in interest rates all the way down to basically zero. And this graph, would basically feature a dramatic drop because we capped it at like this image is a bit dated. We could put the new one where it just basically falls to zero again. So it's a very short-lived rate hike.
What caused the problem in 1980? The interest rates closed over 20%.
Well, there was a bunch of things actually. Chen, did you want to?
That was the Gulf War.
The Gulf War and the oil crisis, yeah.
Yeah, the Gulf War led to the oil crisis,
yeah.
right? Or I think the oil crisis led to the Gulf War.
It's the other way around, yeah.
One or the other, but
yeah.
Yeah. So again, like you guys, if you follow me on the stream, you'll hear me talking about that game of chicken between Russia and Saudi Arabia. These oil producers have that much of an impact on the global economy and on the Federal Reserve, right? Which is why it's extremely important to understand the fundamentals of oil producing countries, because if they make supply output changes, like if they produce more oil or less oil, it's going to have a direct inflationary or deflationary impact on the economy. And if you learn anything from today, the Federal Reserve acts on inflationary or deflationary pressures using interest rate tools. So in this case, I believe during that time, the Gulf War led oil prices to rise really fast, which led to people paying more money for gas prices, which led to the Federal Reserve hiking interest rates in order to mitigate the effects of that. So that's why you have, interest at like almost 20% in 1980s. Now, I guarantee you guys, in your lifetime, you will probably not ever see interest rates that high again.
Yeah.
How about the negative interest rate?
Yeah, we're like if you have to like take a bet on where we're gonna go, like 5% interest rates or negative, I bet all my money on negative interest rates.
Totally be on the negative side. There are actually many. I think it's like don't quote me on this. I'll have to verify, but it's like a third of the world economy is in negative interest rates right now. Okay, so that's basically they have failed to at their mandate to address the monetary policies, and they've had to just dive into negative interest rates. There's a world where it's upside down, right? When you borrow money from somebody, they don't pay you to do that. You pay them, right? That's what interest is. So when you have negative interest rate, it just creates this upside down world.
Not the free money, right?
Yeah, kind of. Well, it's like right now there's three major central banks that are in negative, right? You have the Bank of Japan, the Swiss National Bank, and the European Central Bank with negative rates, right? And what it basically means is that if you want to borrow money, they're gonna give it to you. They're gonna give you money to borrow at no rates, right? And you don't have to pay any interest on it. Right? And it's a policy that they put in place to promote economic growth, right? So the idea here is that with negative interest rates is that if any banks have excess capital, right? So like if a bank takes in money from you depositing your savings into the bank. The way the game is set up by the central banks is that they force the bank that took your money to lend out that money that you just gave them to other people. And it's supposed to promote economic growth, right? It's forcing banks who keep money in their savings account, or basically in their savings account. It punishes them for saving. So
Yep.
banks are forced to lend out money to people. They have to give it out to people. They're like basically saying like, here, they're like shoving it to people. Like, take it. Like that's the idea with negative interest rate policies.
Yeah, but there, it sounds like a great idea, right? But there's consequences to that, right? So one of the consequences is because it encourages lending and punishes saving, it trickles down to pension plans, right? Because when you're retired, a lot of your pension is derived from fixed income assets like bonds, right?
Yeah.
And in fact, I understand, I know for a fact, if you want to be a fund manager and you want to specialize in pension funds, like most of your holdings has to be in bonds. It's a government mandate, right? Because you're dealing with retired people, right? So you can't just blow all their money and have them fucked, right? Now, but the problem is, what are you going to do? You're going to buy bonds that have a negative interest rate. That's not helping either. So it is nice for people like us who understand how the system works to leverage that, to take on loans, to do things with that leverage, right? But when you're older and you've done all that already and you just want to chill and live out your years, that's not necessarily what you want, right?
How about moving to those countries though, with a negative interest?
I wouldn't move to those countries, because the reason why they're in negative interest rates is because they want to promote economic growth.
Well, because their economy stagnated.
Yeah, their economy stagnated, right? And so even if you go to those countries, you're not going to get ahead.
Yeah.
Right. So it's like, it's like you go to those countries, but
what you can look for is a carry trade in those countries, right?
Yeah. So
what a carry trade is basically the U.S. dollar has some kind of yield, right? It has some power because at least for now, we're still we're still in the single digits. We were still in the single digit interest rate percent. Now we're effectively at zero. But if everybody else is negative and we're zero, the dollar is more powerful, right? So you could keep your dollar as collateral and basically shift assets from the thing with the higher interest rate. You get collateral off that, like kind of like collecting a yield, and you're investing in these things with negative interest rates.
Yeah, I got a question though.
Yeah.
Like when the interest rate is like actual negative, do you actually get paid to borrow money, or is that like
you don't, because it doesn't trickle down to you. It affects the banks, right? So what
the
you
bank
will
gets
see
paid negative money to borrow?
So the way it works is as such, right? Like there's a tier system in the banking system itself, right? You have the central bank at the top. So let's use the Bank of Canada as an example. And then you have RBC below that, right? And then you have you. Okay. Yeah. So when they're in a negative interest rate policy, that doesn't mean you're getting rates at negative. It means RBC is borrowing from the Bank of Canada at negative, and they go on and they charge you like 0.5%.
Yeah. So like Bank of Canada pays RBC for borrowing.
Pretty much, yeah.
Yeah.
Oh.
But that doesn't trickle down to you, right? So
yeah.
Of course not.
They have to delve into like -8 or something like that. Currently, they're all in like minus. There's no more than -1. Okay, so you will never see that.
No,
you will just see no interest in your savings, no interest in certificate of deposits. You guys know what those are. Yeah, I mean, you guys already see that, right? But if we're at zero, below zero, you just won't have any at all. I mean, mine's like 0.025 or something, just minuscule, right? But it's there. Okay, if we go into negative rates, you won't have it at all. Okay, so there's absolutely no incentive for you to save anymore, because you're just not getting rates. And like CDs, I remember in my time how a 5-year CD, you get like 5%. CD is a certificate of deposit. It's a type of fixed income product that's just given out by your banks. It's just encouraging you to save wisely. If you have extra money and you don't want to like touch it for a while, you can basically go out and buy a type of bond through your bank, and they just pay you a certain percentage over a 5-year term, 10-year term. You have smaller ones like 2-year term, and less even than the months. And of course, there's track with government bonds and all that. But good luck having any yield at all from those.
So how about this carry trade? Can we do this or no? It's just the banks can do that.
For the most part, it's just the banks, but there's ways you could set it up. We're kind of running out of time here to get into that type of thing. But basically, you want to fund your investments in U.S. dollars, right? So if you take on a loan, you use your U.S. dollars as collateral at the bank. You get a loan in Japan for whatever reason, to buy stocks or whatever, and you're collecting interest from the bank because you have collateral in a currency with much more yield.
Oh, okay.
Does that make sense? Chen, did you have
Yes.
anything to add to that?
No, that's just the basis of a carry trade. I mean, but I mean,
But Jaspreet was asking specifically how we can do it, like people, like normal, like humans.
oh,
But that's the only way I know of. There might be others. Is that you have to actually go and borrow to purchase assets in, take a loan in that negative interest rate environment where your country's currency has more value, and you collect. You let the other thing go down, but you're collecting more from the bank paying you because of the weight of your currency, the interest. You understand?
Yes.
Jaspreet, are you from India?
Yes, I am.
Okay, so right now, if you go on investing.com and you take a look at the interest rate table, right, the RBI, Reserve Bank of India, they're offering you 5.15% interest rate, okay? Whereas in Canada, interest rates is at 0.75%. So the idea of a carry trade for you, to break it down in simple terms, is borrow money in Canada, take that money, bring it back to India, invest it in India. You're going to make 5%. That's a carry trade, basically.
Yeah, so it's like reverse for you, because we're talking about how, our currencies are respectively better than everybody else. That's not talking about you, right? Yours is at in the 5%. Everybody else is in Bank of Japan.
We're less than one. Everybody, there's nobody in the major world or in the major economy that's higher than 1.
Yeah.
Oh.
Yeah.
That makes sense.
Okay, so this is kind of zooming in on the federal funds rate. In the time of most of you guys were around. You guys are probably a lot younger than me, but so in 2000 we had it as high as 7%, right? And that again was due to the effects of another war, right? And then we also had the .com bubble that happened promptly after that, and pretty much exactly around 2000, which drove the prices down almost to zero. They're hanging about 1.1%. We drove back just in time for the recession of 2008. I think that 2008 was the nail that killed the financial system as a whole, because it showed people, and you could see it by the interest rates, right? Interest rates were never able to recover. When they did, they made it there for all of 2 years. They were above zero. Right.
Yeah, you can actually do technical analysis on the interest rates, and it's like a declining bear wedge. Like for anybody who's in yesterday's class on technicals, it's like a bear wedge to 0%, and then it's gonna go negative. That's what it looks like.
No, exactly. And partly because we never solved the problems that and this isn't just me pontificating, this isn't just me riffing, this is fact, right? We never solved the problems of 2008. The big banks were just bailed out to continue business as usual. We live in a credit system, okay? So the only form of asset, only form of currency really is based on credit. It's not based on production, not based on manufacturing, not based on anything else other than credit, okay?
Yeah.
So basically, in a stronger economy, this is why China, and you're seeing this example, this isn't just this abstract theory. No, you could see it. China was able to withstand the Wuhan virus a lot better than the US was. Why? Because it just took a couple cases in the United States, and the fact that China got hit so hard to tank the U.S. economy, to tank stocks, right? Whereas China's chugging along, right? Because they have actual production going on there. Okay, so if the United States had that, we would take a hit for sure. Not saying like that, but it wouldn't be to the effect that we do now, because it's like, oh fuck, China isn't producing. That affects our economy immediately. Then we get the economic hit when we get it because nobody is producing anything. We're all in. If you have a normal job, you're the service people or whatever, or you work at a very large company who has some assets, but all these service people, they don't keep paycheck to paycheck money. So you're going to be facing massive systemic defaults. It's like the everything bubble, not just in housing and credit cards and student loans, everything. Okay, so that's
I have a question for all of you guys before we close out. Do you guys know how credit and debt is created in the markets?
No, I don't know.
Do you guys this is a serious question because I swear to God, guys, in school, they will never teach you this. Do you guys know how credit and debt is created? Because it is a fundamental core concept in the financial system, but nobody knows how it works.
We send them the video that you sent me by
Okay,
So they just press buttons.
Well, no, so Andy, this is how it works, all right? So if you have a job, right, your job leads to future earnings expectation. Like by the end of the month, you're going to make like 2 G's, right? So if you make 2 G's, right, a bank will say, hey, because you have a job and you have income coming in, we'll give you credit off of that job, okay? That's one way credit's created, off of having a job. Another way credit is created is if you have assets. If you own a home, if you own stocks, if you own anything that has value, you can borrow against that asset, okay? That the ability to borrow against that asset is what creates credit, right? Credit essentially expands your buying power without actually having to earn more money.
the question is how the banks do it.
And now, so the second equation to that is that credit and debt are essentially the same thing. Credit creates debt, debt creates credit, right? So when you have the ability to borrow money on credit, when you spend on credit, you're spending money that you don't have, right? And so that money that you're spending now is a liability to you, but it is an income asset to the person that gave you that credit. So usually a bank will give you credit, right? If you're spending money you don't have, you're essentially going into debt, and then that debt becomes the bank's asset. And so that's essentially how new money is conjured out of thin air in the markets. Okay.
Yeah, but the point is, how do the banks actually go about that themselves, right? Do you think that they lend you money that they have? No,
it's a fractional. It's like 1/10 or something.
No, I wish like it's as high as so the actual credit, the actual what we call derivatives, just a fancy word for stuff that doesn't exist. The derivatives to assets in most banks is like 24-1. In some banks, it's as high as 200-1.
Yes.
Okay, so things that they don't own to things that they own, 200-1, right? So the banks can just do it, right?
Yeah.
And this is another reason why the Federal Reserve exists, because if they do it just profligately, guess who bails them out? It's the Federal Reserve. They just come knocking on the door, and they literally can make it out of thin air because they're a central bank. That's what they do. So that's just,
an interesting point to know for you. If you go back to that interest rate chart, I want to point out a point here for you. In prior to 1971, okay, the US dollar was linked to gold. If you guys remember in the forex module that we covered, once upon a time the US dollar was linked to gold. Because the US dollar was linked to gold, you can't create new credit or debt in the system, because anytime you create new credit or debt in the system, the person who owns US dollars will be like, hey, let me exchange these dollars for your gold. Okay, that depressed the ability to create new debt and credit in the system. So in 1971, what Richard Nixon did was that he removed that link between gold and the US dollar. And if you take a look at US debt to GDP ratio or Federal Reserve balance sheets, from 1971, it goes on a hockey stick growth, right? It goes up like a hockey stick. And the reason why it does that is because with the removal of the US dollars linked to gold, it allowed the system to conjure new money through credit and debt. All right. So that's a very, very important concept to understanding the markets. And it affects everything, especially in the bond market, and because the bond market is essentially the safest market in the world, right? You get a yield for when investing in bonds. It affects that market, and then that will affect every other market. Danny and I have a saying in the markets, right? Smart traders are trading in the bond market. They're not trading forex. They're not trading gold. They're not trading stocks. They're trading bonds, right? The most sophisticated traders in the world, they're trading in the bond market because that's the smartest market in the world.
Isn't all this gonna bite us in the ass at some point, Chen and Dan?
Well, didn't it already?
Yeah.
No, I mean like in terms of like hyperinflation or whatever.
Oh,
Yeah,
absolutely. You're going to see that
absolutely.
now. You're going to see that now. There's no reason you could just keep dumping money into the economy saying you're going to have unlimited purchases without having that have an effect on the economy. And we've seen it too before in Zimbabwe and Venezuela. You have seen this.
Yeah, and if you watch the stream when I was talking with Phil, right? Yeah, it's gonna lead to hyperinflation. You're absolutely right. But there are ways in which they're gonna work themselves around it very politically, right? So, for example, okay, they're gonna hyperinflate your currency. So, if you go to buy a coffee from Starbucks or Tim Hortons, expect to pay $5 for a coffee very soon in the future. A Big Mac combo, expect to pay $15 a Big Mac combo. But wait, just to not piss you off, Andy, we're gonna give you $15 an hour for minimum wage. We're gonna raise the minimum wage. Okay, we're gonna give you $20 minimum per hour, right? Just to make you happy. But will it make any meaningful change to you if you're making $20 an hour, but now a fucking Big Mac combo is $15?
No, you have to measure in terms of like the hours.
Well, yeah, and not only that, but when things go up, everything goes up. So that $20 an hour means nothing if you're paying $600 a month for rent. Now it's $800, right?
Yeah. Exactly, right. So that's the idea of the hyperinflation and the impacts that it has on your currency and your purchasing power, and traditionally how politicians will fucking worm their way around into selling this to people. They're gonna start giving you like $18-$20 an hour minimum wage, like that fucking pass. And most people, again, the majority of people have no clue how the financial system works, right? So most people will just be like, oh, $20 an hour? Fuck yeah.
Yeah.
Right.
Exactly.
So that's the idea of how things will work. I mean, like, hopefully now you guys are at least more educated and you understand how the system works. And again, I mean, like, if you can, take advantage of the environment now and just try to make money and better your life, because the way the financial system works, it is not set up for guys like us to succeed. It's set up for guys like us to be enslaved.
Exactly. That's a good note to end on this.
Yeah. So yeah, well, that's a very good note to end.
All right, guys. Well, hey, thanks for tuning in, and this was a really great class. We're gonna next time we're gonna finish this up and talk a little and return to technicals a little bit. I want to talk about Elliott Wave, but thanks for tuning in. I know this was a long class and a lot of hard material, but it's very, very interesting. This is the reason why we're here, and hopefully, we can help you guys actually take this information and make something from it. So, again, thanks for tuning in, and I'll see you on Monday.
Yeah, have a great one, everyone, and we'll be back tomorrow morning for the streaming sessions.
Thank you, guys. Thank you for a great class. Great class. Great class. Thank you.
Thanks, Chen and Dan.
Later, guys.
Bravo.
All right. Thanks, guys. Take care.